In the last couple of days, we've seen 14 million ounces of silver in JP Morgan's vault transfer from eligible to registered. Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics on an active Tuesday morning in the gold and silver and financial markets. And fortunately, once again, joined by Andy Schectman and Miles Franklin for this week's physical silver report. A lot happening in the silver world, especially over the past couple of days. We see these 1,000-ounce bars behind me, and some of them are moving around, which we will dig into, as well as getting an update on premiums and covering a few other things. And with that said, Andy, it's a pleasure to welcome you on in as always each week. And how are you doing today, sir?
I'm doing good, brother. It's always good to be here. Good to see your face. I can't wait to see you in person here pretty quick. I know you're on your trek down this way, so it's been too long, but never something that won't be embraced. I can't wait to see you. So glad to be here, buddy.
Well, we've been driving around, dodging hurricane reports and maybe a flat tire or two, but all good stuff. And although people don't want to hear about that, I think what everyone is probably already seen by the time this airs in a couple of hours is that we did have nice little spike here in the silver and gold prices. Silver up 40 cents on the Kitco chart. We see gold had sold off around 6 o'clock this morning. Nice little V shape and then spiking back up. And as we take a look, we can see the dollar spike down. Looks like this move largely driven by a much weaker than expected consumer confidence number that came out at 10 a.m. But in net, interesting, once again, now if we go back to the beginning of the year, seeing silver around 24.30 level, back into positive territory. Might not feel like that to a lot of people. It's been a volatile year with a lot of ups and downs, but why don't we start there, and just any thoughts you have on this morning's move or elsewise, or things that you are seeing out there in the silver market today?
Yeah, two things come to mind immediately. One is that the people in this country, or the markets rather, work too much in terms of the immediate information. It's what just happened, what's happening right now. It ignores the very big picture. I wonder, does the fact that the commercial banks are net long in the silver futures for the first time in a very long time has anything to do with these types of moves? Is this the beginning of a substantive move a lot of us have been waiting for, or assuming would have happened a long time ago? I'm not sure, but is the nature of this market where there is a piece of information that comes out like consumer confidence fell. Well, duh. You can see that we're in a period of time where there's strain on the consumer with inflation and higher prices, and the economy slowing down in a very big way. But is that enough to make silver go skyward? Question is, does the conventional wisdom, does that say, well, worse than expected consumer sentiment, so silver should go to the moon? In other words, is there something behind the scenes that is bigger than that information, or is that information, kind of the cover to run for showing the positioning of the commercial banks in a very bullish stance? So I've been expecting this blow off, and I think it's going to continue to go higher, in my own opinion, based upon the positioning of where the most informed traders in the world are, and that is net long in futures. So yeah, whatever the reason is, I'm glad to see it. It's long overdue, and I would anticipate that this run is not over yet. I think it's just beginning.
Okay, and something that you said in there reminds me of a topic we covered about a month or two ago here on the show. This is a very unofficial analysis, yet something that I've thought about over the past months and years, where just in terms of blow off top, as you mentioned, here we have the silver chart going back to the mid 70s. And obviously on the gold side, we've seen as money printing and debt loads have accelerated, the gold price has gone up with that. Whereas silver, a lot of people saying, all right, well, here's silver, the inflation hedge, still half of its 1980 and 2011 highs. Although something that I've at least considered is that if you look at the move in 1980, obviously you had big inflation leading up in the 70s. I don't think the Hunt brothers explains that entire move, because again, you had gold spike up in 1980 and the Hunt brothers weren't taking large delivery of gold contracts. But you had enough concern that Paul Volcker had to do something that was pretty unprecedented back then, that I don't think many people expected would actually take place. So you could say that the fear gauge perhaps went up quite a bit then. And similarly in 2011, when they were launching QE2, a lot of people is thinking, hey, well, this doesn't sound so ideal with all that debt monetization. So what would you say if you considered those two, silver's response to the fear gauge spiking in the markets? Because if you take out those spikes, you can see that the curve here, and again, this is very unofficial or unmathematical, but without those two spikes, silver not entirely dissimilar from a gold curve, where you see it really starting to escalate over the past 20 years. Obviously, the two spikes to $50 are an important part of silver, and that's something that drew a lot of people's attention. Yet when we're sitting here today with almost $25 silver, that's actually on the higher end. I mean, you take out this spike in 2011, and we're basically at the highs all time of silver historically. So long question here, but what would you say that maybe silver is doing its job, and in terms of inflation, and it's really when there's a panic or a fear gauge set off in the market that leads to those spikes, which again is something that, you know, if we look a little longer term ahead about the situation with the Fed and the debt loads, is something that in time people might be concerned about. Maybe might not happen today or tomorrow, but any thoughts on just that sort of approach in silver?
Yeah, well, let's go back to 1980 first, when Volcker raised rates to, almost 19%. We also didn't have the debt burden that we did back then. So he had tools in his quote unquote toolbox, enabling him to raise rates high enough to bring into effect the term Gibsons Paradox, which is the inverse relationship between real interest rates and the price of gold. The real interest rates in the United States right now may be 1%. And that's if you believe the CPI gauge. I mean, we're very, very close to 0 or 1% in terms of real interest rates. But back in 1980, when the inflation measurement was actually fairly accurate, we had a real interest rate environment of, after he raised rates to 3-4%, which certainly was better. But the point of it is that we didn't have the debt burden that put the massive strain on the government. And when you can earn 18 or 19% and put it into treasuries with safety, the rule of 70 seconds would tell you in 3.5 years you double your money. That would be the death knell for things like gold and silver that don't pay a coupon. When you look at 2011, you still had optimism in what the United States was all about. And when you talk about the growth of debt since 2011, I mean, look at the amount of debt and the amount of money printing that has happened just in the last 4 years. So I'm not saying we didn't have a substantial debt in 2011, but my guess is it was probably, the national debt was probably somewhere between 17 and 20 trillion. And here we are right now with, 50% greater addition to the debt and accelerating. So the point I'm getting at is that the ability to mitigate the rise in gold and silver, which would really be the antithesis of the Western system. The Western system has suppressed gold and silver forever to support the bond market, to create the illusion of strength in a dollar and in a system that perhaps was starting to show cracks. And in 1980, it was easy to brush off. In 2011, it wasn't easy, but it was easier to brush off than it is now, where you have an increasing debt burden. And as rates rise high enough, you blow up the entire system. So they don't have those tools in their toolbox anymore. And the fact that it is slowly, methodically rising, to me, is much, much, much more encouraging than something that goes straight up to the moon in a hockey stick fashion immediately, because those runs are typically never sustained. You want to see something slow and methodical that continues to build. And to your point, which is very, very, it's articulate, and it's also The word I'm looking for is escaping me. It's very thought provoking as far as I'm concerned. And, it just shows that you're looking at this the right way. You're right. If you go back and look, you've never seen silver move in this way where it continues to move higher and higher and higher and backfill and higher and higher and backfill. Typically, we see these massive spike moves, but I think it's more encouraging to see it this way. When you put into the equation that the commercial banks are now net long, now, does that mean that they'll be net long and that they won't short a rising price? That's really where the rubber meets the road, is that if the commercial banks do not short this market as it continues to move higher, then we know it's the real deal, because that's been their mantra. They're the only idiots, and they're not really idiots because they have enough money and they know what they're doing, to short a rising market. Typically, you short a falling market. Shorting a rising market tells me that they are trying to manipulate the managed money again. They've hoodwinked the managed money into going very, very, very short. And when you look at the amount of silver that is literally disappearing off of COMEX and off of SLV, when you read the ETF, BlackRock, or the SLV ETF prospectus, and look at the note that BlackRock sent out a couple of years ago, they said, hey, by the way, for all of you that decide to short SLV, there could become a time where you can't get the bars to cover it. And kind of a warning in the sands, if you will. We are entering a period of time where being short in this market is incredibly dangerous. So although we are seeing it move up and up and up in a methodical fashion, there certainly is that rocket fuel there that could push it higher. But this time, the question is, will they stop it? Do they want to stop it? And even if they do, how? You can't raise rates to stop it like Volcker did. And in terms of what they did to the Hunt brothers, maybe they changed the rules. I don't know. I look at it as very bullish. To me, you want slow and methodical. You want the tortoise. You don't want the hare. The hare runs out of breath and collapses like we saw in 11 and like we saw in 08. But we want a slow, steady base build that continues to build strength underneath it in an environment where physical silver is becoming impossible to get at that level. So I find it to be very encouraging, to be honest with you.
Yeah, and you mentioned the positioning by the banks in silver recently. Will be certainly interesting to see how this week's report comes out, because fortunately the COT that's released on Friday will cover today's move and also the day last week. I believe it was Thursday when silver moved up almost $1. So we will see if there was more shorting on that recent move up. Will tell us a fair amount. And one other note on what you mentioned here, I think you said around 17 to 21 trillion by 2011. We were still back in the 14 to 15-ish range, although rough data point I always remember is during the Bush years, we went from 5 to 10 between 2000 and 2008. Then over Obama's term, doubles again from 10 to 20. So certainly getting into that exponential portion of the curve, which again is why so many of us are looking to things like gold and silver as protection.
And look at that chart, Chris. Go back to 1980 and you can see why it would have been easy to raise rates. I mean, yeah, you're going to blow up the economy and you're going to create some problems, but at that level, you don't blow up the government, you don't blow up the debt, you don't blow everything up, because there was virtually, in comparison today, no debt. And we're giving more money to the Ukraine, it seems, than we had in the debt back then. So that's really the issue, is that we have now exhausted the ability to do something like that without creating a catastrophic event. You would literally blow up everything in this country, stocks, bonds, and real estate, bang, just like that would be gone if he tried to raise rates to 20% like Volcker did. So those options are pretty much off the table unless you call it the nuclear option and you reset the whole system. Klaus Schwab may like that, but I don't think Fed Chairman Powell has that in mind.
Yeah, and I still think before it's all said and done, I wonder if that's not an inevitability, whether that might be a bit farther out than some might think yet. You wonder how all this gets resolved. Obviously, during debt ceiling negotiations, never was much talked about, well, how do we ever repay this? So imagine that will keep going, obviously, with the current spending levels on track to do so. Although I do want to shift over to some news that we referenced in the beginning, but in the last couple of days, we've seen 14 million ounces of silver in JP Morgan's vault transfer from eligible to registered, which leaves their eligible category now at just under 14 million if you subtract out what they're holding for SLV. So a big jump there. Again, this is obviously ahead of the September deliveries in just a couple of days. So we see, I'll back us out to the 1 year that has gotten down to that 27 level, jumped up jumped up again before July, and we're seeing a similar jump here. Same time, we had a note from Bob Coleman yesterday mentioning that the shares available to borrow in SLV just collapsed. In July, there was as much as 8 million shares available to borrow. August, there were 4 million. That just collapsed to 500,000 shares as of yesterday. So some big shifts in the industrial piles, and just curious if you have any thoughts on that, if there's anything that you're seeing from the people that you've been talking to and what you could shed some light on there.
Yeah, I think Bob Coleman's a smart guy. I follow him on X, or if you call it X now, on Twitter. I think he comes up with some great insight. So kudos to him. As far as the JP Morgan shifting all of that metal into registered, I mean, it's my belief that there's probably already been a deal made. It's not that they're putting it into registered to offer it up for sale. My guess is it's already been sold. And when you deliver off of COMEX, you have to transfer it from eligible to registered. I mean, as an example, we have a Brinks program with 10 or 11 vaults all around North America. Of all of the vaults we have, the one in New York City, JFK, is a COMEX depository. Out of all of them, it's the only one that is. And I have clients in there with over 1 million ounces of silver. A few of them each have over a few million ounces in 1,000-ounce bars. Those bars are eligible, meaning they are eligible if the client decides to register them. They are eligible. They have been assayed and meet the criteria of a good delivery bar by the COMEX standards. Eligible, ain't for sale. But if they decide, hey, I want to sell it because someone's offering a big premium, maybe it's Elon Musk or whatever, hypothetically, they have to be transferred first to registered. Well, if they transfer them to registered, then they are for sale. But what if the deal was already made and they are going to take possession of this copious amount, 13, 14 million ounces of silver? Some entity, a client of JP Morgan's, let's say, is going to take possession. Well, you would have to transfer it first to registered. Now, the question is it going to leave the ecosystem? If we see these bars leave the ecosystem, it fits part and parcel with what I've been saying for the last 3 years, that there are entities of great sophistication that are leaving the COMEX ecosystem. It is a one-way ticket. When you take possession of those bars outside the system, you have now, in essence, cut off their industrial liquidity. They would need to be reintroduced into the system and reassayed at a considerable time cost and actual physical cost of assaying those bars. So when they leave, they're not coming back. Question is this for delivery on a deal that's already been prearranged with JP Morgan? My inclination is yes, it is, that they will be delivered. They've already arranged that, because typically when we see these big spikes, like, a few weeks ago, we saw it go from over 27 million ounces to well over 30, 34, 35, whatever the number was. And you and I were talking about it at the time, but then it went right back down again. Does that mean that someone took possession of it? Yeah, absolutely it does. And I don't know that it has anything to do with them offering it up for sale or not. I guess we'll have to see how that all plays out. But in terms of what you were talking about SLV shares, the shares that are eligible to be loaned or lent against or naked shorted, that Bob talked about, I found an explanation of that. I'm going to read it to you here. It says, over the past month, JP Morgan Chase has been steadily retracting borrowable shares of SLV to ensure that they have sufficient physical silver on hand to meet delivery obligations for contracts. Oh my gosh, what does that sound like? The delivery obligations for contracts that just ended up in registered? Could that be? Maybe. They only need to transfer the surplus silver acquired from retracting these SLV shares, which they did, to the registered category, which they did, a few days prior to delivery. which they are doing because the first delivery delay, I think, is just in a couple of days here, September 1. So hence, as the delivery date draws near, JP Morgan Chase would make concerted efforts to shift silver into the registered category. And a coincidence, interestingly enough, is that we have been seeing a substantial drawdown off of SLV. This is one of the preferred ways for the commercial banks to do these covert maneuvers that carry much less scrutiny and attention than moving things in and out of registered and eligible do. So yes, I think it is explainable. I personally believe it to be bullish. I don't think that they are dumping this onto the market. I think it's already there's a deal already in place, and this is just going to leave the system. If it leaves registered and leaves and doesn't go into another eligible account inside of COMEX, to me, it becomes exponentially more bullish. I guess we'll have to see over the next few days.
Yeah, and one question on what you mentioned in there about having a couple people that have accounts where they're storing their silver and eligible, and whether people might or entities might shift that at a higher price. Obviously, don't reveal any client confidentiality, and again, you don't know what each person is thinking, but just to the degree that you are talking to people like that, do you have any feel for, is there, if we get $30 silver, that some of these types of holders might be willing to sell, or they're the type of people that have those accounts not looking to sell anytime before 50? Do you have any feel for what kind of price would make some of these types of clients be willing to sell or shift their metal into registered?
Well, I think if you see $50 level breached, a lot of people will give it strong consideration. As we've talked about before, that's kind of this mythological bar that everyone is trying to beat. That's kind of like the 500 home run club in baseball. Get over 500 home runs, you're pretty much guaranteed the Hall of Fame. Well, that's the bar here. I think you get above $50 and now you're in uncharted territory. So I'm not sure, but I think maybe more appropriate way to answer that question would be if we see a ratio between silver to gold really break down and get into somewhere below the 40-to-1 range. I think you would see a lot of people sell silver and shift to gold. And because I think when you reclassify gold as a tier 1 reserve asset, and you see the central banks buying gold, not to diminish silver whatsoever, I think it's the most undervalued asset on the planet. I think it's the play of a generation. But you could argue that a lot of people are holding large amounts of silver and playing this gold to silver ratio. I think that would pull just as many people out of silver and incite them to sell and switch to gold as you would seeing silver breach 50. I think you could look at either one of those outcomes or both of them, and you would see some selling in silver. But typically, most of the people, I'll be straight with you, I haven't had those discussions with either of my two very large clients who have these huge portfolios there, or any of my clients really finding a number. And I will also add to that this is why they say there is no bull market like a metals bull market, Chris, because using conventional wisdom, if this was Apple stock or whatever it was, and we reach that bar, that level where we're in rarefied air, yeah, you'd be foolish to not want to sell it, take some gain, maybe leave some of the initial investment there and reallocate your money into something of better value. But when it comes to metals, the higher the price go, it only reinforces people's mentality employed as to why they bought it in the first place. And the higher the price goes, actually frightens people more that, geez, I was right. The dollar's in trouble. The world's accumulating silver, et cetera, et cetera, et cetera. It's the opposite. The higher it goes makes you more concerned and frightened that, geez, I was right all along, that things are not looking good. So it's not about making a profit as much as it is saving your ass. And I think that's one of the things that differentiates a precious metals bull market from a traditional bull market, because traditional bull market, it's about making profit. This side of the thing, of the coin, where you're talking metals bull market, it's about validation that the world is in trouble and you're less likely to want to dump it at that level. So it's an interesting phenomenon altogether. In a very long answer, I think it's either above $50, you'd see a lot of selling or certainly interest in it, but more so I think the ratio between gold and silver breaching 40, you would see a lot of people shifting to gold.
Makes a lot of sense. And Andy, there's something I've been meaning to run by you the last couple of weeks. This is news that came out about 2 months ago, yet something we didn't get a chance to talk about, and that was Texas. Now, this has not gone through, but they were looking to invest $5 billion into precious metals, $4 billion worth of gold, $1 billion worth of silver. Again, we'll see if that manifests, but wondering how hard would that be for them to acquire $1 billion worth of silver? Any thoughts on how they might do that or what form?
Well, I mean, the only way they would do that would be slow and methodically. And if this really came out in July and they were talking about it, maybe they've been trying to accumulate it slowly and methodically for several months, or maybe they've already started. If you tell the world we're going to buy $1 billion worth of silver, you have just created a problem, because people will try to front run that. You'll end up talking yourself right out of your trade, in the respect that, you know, when you're talking a finite pool of availability, $1 billion is not just chump change, certainly. Not to mention 4 billion and or what is it, 4 billion worth of gold. This is not chump change. I'm assuming they would have to do it primarily in COMEX bars. The gold side of things wouldn't be as hard as the silver side would be. But Texas has led the way for a very long time. You can go back to I think Mark Bass is his name. What's his last name? Is Bass. I forgot his first
Kyle
name.
Bass.
Kyle Bass. So he ran the fund that took care of the Texas school teacher endowment fund. And I think they bought somewhere in the neighborhood of $1 billion worth of gold. And they bought it in GLD and then took possession of it. You have Texas leading the way with allowing gold and silver to be legal tender for all debts, public and private. You have them talking about making this new currency back, this cryptocurrency, or this digital currency backed by gold and silver. It would not surprise me whatsoever to see that they're serious. They built the Texas Bullion Depository. They're leading the way in this country in terms of their appreciation and understanding of freedom, of liberty, of the way that the Constitution defines money. All of these very, very, very important things that have been lost on the public, certainly not lost on our leaders who have tried to push us away from what the founding fathers described as money. In fact, they call it treason to produce anything other than species, which is gold and silver, as money. But Texas is bringing us back there. How do they do it? Slowly and methodically and quietly. And you wouldn't, maybe you make that announcement and then that's the last thing you hear until it's filled. Because when I have a very, very, very large order, like we talked about, we did two orders last year of over $50 million. And when I try and fill those orders, if I'm buying 1 million Silver Eagles, I am not telling every dealer I talk to that's what I'm doing. I say, what do you have? I'll take as many as you have. And I quietly call another dealer. You do not broadcast it, or you end up crowding yourself out of your trade. So I would not put it past them. They have led the way, and they've already shown us that they view precious metals as money. And God bless them for doing that. But I don't think you'll hear about how it will be accomplished until after it's accomplished, because that's how you would do it. You tell the world what you're up to, and prices go up, availability goes down. It would be the wrong thing to do. And if they're articulate in this market, they will understand that. My guess is that's exactly what they're doing, and that's why it's gone dark. You're not going to hear anything until it's filled or near filled, and then they'll tell us how they did it.
Yeah, and of course we have Bill Holter down there in Texas, so we never know who he's talking to, and maybe encouraging some investment there. Joking as I say that, but
he'd be one of the guys that I'd go to.
Well, could imagine. One last one before we wrap up here today, Andy. Just any updates on premium levels over the past week? I know Silver Eagles had been ticking back a little higher, but anything that has changed since we last spoke?
Yeah, Silver Eagles are going up. They've gone up again, another 15 cents. Quietly, they are moving higher. They represented such a horrible value for the past 3 years, and all of a sudden became a decent value. And that has not been lost on the public. They have gobbled them up in a voracious fashion. And quite frankly, I think it's a smart idea. I look at the 2023s as being an incredibly low mintage year. Go back and look at the 1996 Silver Eagles, which had such a low mintage, and the premiums on them are super high. I could see something like that with this 2023 issue, but they are climbing, indicative of massive demand and pent up demand, where people were fine, I'll buy bars, or fine, I'll buy kangaroos or whatever, not really what they wanted. And then again, you look at a state like Texas, who says all American made coins, past or present, would be used as legal tender for all debts, public and private. They're one of the few that says only American. Most of the states have any government issued, sovereign mint issued, past or present silver coin. But here again, if I had my druthers 10 times out of 10, I'd buy the Silver Eagles over anything, as long as the premiums were low enough. And I've been consistent over almost 4 years. I told everyone, don't buy them. They're too expensive. Even where they are right now, I think they are a decent buy. Every company in America is $6 or higher. We can do a little better than that for your listeners. But the point of it is that it's a situation where I think you will see rising premiums over the next several months, and all it will take will be one bank bail-in, a bank failure and a bank bail-in. And I believe Moody's and S&P did what they did to clear their conscience, to say, we put it on record. There is going to be bank bail-ins. There is going to be more bank failures. And, the reverse repo market, which Rafi talked about a few months ago, saying, well, they're probably going to stop allowing the money markets to invest in the reverse repo market, but they didn't do that. They are continuing to allow the big banks to invest the money market funds into the overnight reverse repo market at a rate higher than a 1-year CD in a regional bank, who's only paying 0.5% on average or less in a savings account. And they're all in big trouble. That sucking sound you hear in the background is all of the money leaving the regional banks. And as more and more strain gets put on these banks, as there's a run on the banks that's probably already happening, but they're not telling us about, these banks are forced to sell their longer duration securities, their 10-year treasuries, which in and of itself pushes rates up, which is a self-fulfilling prophecy. It will obliterate the banks. All of it's going chasing yield and safety in a bank that won't be bailed in, that is not systemically, at least according to Janet Yellen, too big to fail. It's going to happen. And when that happens, and I swear I see it happening as clearly as anything, and maybe it's PNC, maybe it's Schwab. Who is it? I don't know. These banks have 100, Schwab has 130%, I believe, or in that neighborhood, of their assets, the value of their assets in this short-term lending program that's due back in like 6 months. They were just underneath Silicon Valley Bank on the chart of those banks that are in trouble. So you see a bank like that fail, and the government finally does what the Dodd-Frank law said they're supposed to, let it be bailed in, and watch what happens in this country. People will lose their freaking mind and freak at a level. It'll be the first thing that's happened in a maybe ever in my career, where people finally wake up and say, holy shit, this is real. I don't care what's happening in the BRICS. I don't care what's happening in the market or the real estate. All of that stuff is there and is very relevant, but the people haven't seen any of it. What will they see? When their money is evaporated and goes bang like that into a bail-in process, where the realization that the American consumer who has money in a bank is actually an unsecured general creditor, not a depositor, but an unsecured general creditor of a bank that is making horseshit bets with your money, and now you have to bear the burden for it. When that happens, you will see chaos like you have never seen. And that will be the moment that I have seen in my mind's eye forever, the supply-demand Rubicon. When the public says, where do I go? Oh my God, silver, gold, bang, and it's gone. That fast it will disappear, because all of these delivery issues that we've had, Chris, and the supply issues that we've had, it's been the pimple on the elephant's ass that's getting a little bit bigger by the day, but not the elephant. That elephant has really never even thought about gold and silver. And while this is something that you and I beat ourselves up on all the time, thinking that everyone sees what we see, believe me, Chris, when the public wakes up and finally understands what's going on, the information that you've been giving for the last couple of years, they'll be like, where the hell, how have I not found this guy before? Why have I not looked at this before? Because it's one thing to talk about what's happening to the markets and the instability and the potential danger. It's another thing to say that since we were little kids putting pennies in a piggy bank, everything that we ever learned about a bank is that it's safe. And you know what? Most people in this country don't even know what a bail-in is. Most people have never heard of Dodd-Frank. Most people don't know that bail-ins were written into the Dodd-Frank law. Most people don't know that they are an unsecured general creditor. Why would they worry about keeping $500,000 in their, or $1 million in their savings account? Well, they will realize very quickly, as will everyone else who stands by watching a burning car wreck. Oh my gosh, and how fast will they run to their local branch to pull their money out immediately? And then what happens? It begets more, which begets more, which begets more selling of the treasuries and the mortgage-backed securities that are on the balance sheet, which raises rates higher, which puts more strain on the banks, and everyone's running to them. Do you see how this rapidly spirals out of control? And you know what's interesting? Kristalina Georgieva, the head of the IMF, you know what she said? The problem with the US banking system is regulation, that the people are able to pull their money out of the banks too quickly with the click of a mouse. Watch what happens this time if you see a bank bail in. And I believe, I'll put it on record, I really, really, really believe that's coming. You know what? That's exactly what Lael Brainerd, modern monetary theorist number 2 in charge at the in terms of economic advisory at the White House, wants. It's coming, I'm telling you, and you ain't seen nothing yet. So these are interesting times for sure, as the Chinese curse says, but I honest to God believe that we haven't seen anything yet. We see it, but all of those people out there not watching this show, but all the people, your family and friends, for all you people out there who you've been trying to warn about precious metals and what's going on and help, noble cause, falls on deaf ears. This will certainly open up their earbuds and they will be listening to what you have to say. Where did you buy it? Where did you buy it? Who are you listening to? Help me. And I believe that's coming. So maybe I'm being a little dramatic here, but I think it's coming. I think bail-ins and more bank failures are on the horizon. And I think S&P and Moody's did that to clear their conscience. Here we go. Buckle up.
Well, got a little taste of that earlier this year and does not seem like we've seen the last of those issues.
Yes, but we got bailed out, which was illegal. And real quick, I know you want to wrap this up and I got to go here too in a minute, but here's the deal. They bailed them out, and no one asks except for the senator and the Republican congressman who said to the head of the bank, "Why did you have $14 billion in checking accounts, 10 of them, for 3 years? Why did you have $14 billion in 10 checking accounts? Where was risk management for the business, for the bank? Where was the FDIC then? Who would have ever allowed $1.4 billion on average in 10 accounts in a checking account for 3 years in Silicon Valley Bank, earning 0 interest with $250,000 guarantee? Where was risk management? Is there something a little bit wrong with the fact that that bank was bailed out instead of bailed in? Should these people not have felt the consequence of completely ignoring the law in terms of what is bailed in and bailed out? The whole thing stinks to high heaven as far as I'm concerned. But think about that for 1 minute as we leave here. 10 checking accounts over 3 years held $14 billion in them. No FDIC insurance above 250, 0 in the way of interest. How about put all that money into treasuries with no bank risk, earning 10, 20, 30 times what they were getting in a checking account? This whole thing reeks to high hell, and there's a fine line between conspiracy and reality. But I'm telling you this, what was lost on everyone in March and April was that those banks were bailed out, and that was not what Dodd-Frank said. Janet Yellen said, well, they're too systemic. We needed to make a decision to protect the system. Bullshit. They should have been bailed in and lost it all, like some unsuspecting members of this country, of citizens of this country, are going to face in the next coming months or sooner. So anyways, at least I put it on record saying I believe that's going to happen, and I hope it doesn't. But for those of you who have over the FDIC limit in any regional bank, what the hell are you doing? Time to move. So anyways, Chris, it's always good to see you. I can't wait to see you in person here real soon. And of course, I'll look forward to checking back in with you next week.
Yeah, and Andy, before I let you go, just for anyone who is in the market for silver, anything on special that they can look at?
Yeah, I believe we're doing the 1 ounce silver rounds. Let me double check here. I believe it's the 1 ounce silver rounds at 250 over spot, but let me make sure. Asahi. No, they're Asahi silver rounds, which are some of my favorite. Hope you can see the picture. There it is right there. Asahi silver rounds, 250 over spot. Asahi is probably the highest quality round in the industry, or certainly one of them. The old Johnson Matthey Corporation. So 250 over spot for the Asahi silver rounds, and they are in stock, ready for immediate delivery.
All right. Well, Andy, thank you as always. I know you have another call coming up, so we'll let you run, but appreciate this.
Love you, brother. I'll see you soon. Thanks for having me, Chris.
Well, thank you, Andy. Appreciate the update as always. And thank you to everyone who's watching at home. Hopefully you found that update helpful, especially as we've seen some silver on the move in the last couple of days and ahead of the next delivery cycle, which will be beginning in just a couple of more days. So that will provide another clue of where things are headed from here. So certainly we'll keep you posted on that. And real quick, before we wrap up, would just like to thank BlackRock Silver, who brought us today's show. Obviously, BlackRock Silver has its flagship project at Tonopah West, where they released a maiden resource estimate that came in with over 42 million ounces of silver equivalent last April. They've done step-out drilling to the northwest in the time since then. Next drill program will be doing some infill drilling in that location, which will be part of helping them to update this resource estimate, where they are expecting to be adding tonnage to what they have already found here. So especially for those of you who are into the silver mining stocks, BlackRock Silver, a company to be aware of, as they have continued to have success, not just at Tonopah West, but also their Silver Cloud location, as well as their lithium project, where they found mineralization at Tonopah North, have a joint venture going with Tierlock Resources, all of which you can find out more about at blackrocksilver.com. So again, thank you to BlackRock for helping us to bring you the show each day, and going to wrap up for now, but thanks for being here. Hope you're having a great day out there, and I'll see you again tomorrow.